welcome to Looking at the Markets with David Modell. I'm going to talk about strike price selection today. What is the best one for buying and for selling? Well, it depends on the situation, of course, and don't take my advice just because a guy in a video told you something. You have to make your own decisions, do your own research, do your own due diligence. And also make sure you have a plan, by the way. I do help people with that. So if you'd like some coaching, you can email me at davidmodell@gmail.com if you'd like some coaching to help you put together a trading or investing plan, if you need help with options or stock trading, whatever it is that you're trading, I can usually help with that. So feel free to email me for the coaching. All right, so I'm on my Schwab account right now, and I'm using the SPY, that is the SPDR S&P 500 tracking ETF. It tracks the S&P 500. It's a basket of 500 stocks in the index. So it's not going to be something that typically moves 5 or 10% in a day. I mean, it can, but for SPY, a 0.42% move, that's a moderate move. That's a decent move for a basket of 500 stocks, right? So you'd think that the call price would go up, right? I mean, if the underlying asset, if the underlying ETF went up a moderate amount, you'd think the call price would go up. Not necessarily. The Black-Scholes formula, which is the formula that the options market uses to calculate options prices, yes, it factors in the price of the stock or ETF or whatever the underlying asset is. But it also includes other factors in the calculation. It includes the volatility of the underlying asset. How volatile is it? How big are the moves up and down? It calculates the time decay, or theta. How much time has passed? How much time is there left until expiration? And it includes the strike price. That's important. All right. How far away is the strike price relative to the current price? That's part of the calculation in the Black-Scholes formula. So, and that is a major consideration in selecting the strike price, whether you're a buyer or a seller. Now, usually, not always, if I'm going to buy a call or a put, generally I'm going to prefer to buy something in the money. All right. So in the case of a call, I'm going to want to buy with a strike price below the current price. Not too far below, because then it becomes expensive. But oftentimes it'll be 1 or 2 strikes in the money. Same with puts. If I'm going to buy a put, usually it's going to be 1 or 2 strikes in the money. Not always. Might be 3 or 4 strikes. It depends on the price of the stock or ETF. Because, for example, Amazon, 1 or 2 strikes is a lot. 2 strikes in the money is a lot for Amazon. Whereas for Ford, 1 or 2 strikes might not be enough because it's such a low-priced stock, okay? Whereas Amazon is a very expensive stock. All right, so it's not always 1 or 2 strikes, but that's pretty typical. All right, so now, again, the underlying ETF here, it went up moderately. So you'd think that an at-the-money call would have gone up, right? I mean, that would make sense. And I'm using today as the strike price. All right, it's going to expire today. So this is approximately at the money, not exactly, but it's pretty close, right? 315.70 versus a strike price of 316. Let's see how the call did. It did not go up, okay? Actually, compared to compared to yesterday's closing price, the at the money, approximately at the money call option went down 22 or 23%. All right. So that just goes to show you that buying an at the money option, not necessarily a good idea. Okay. I mean, this kind of movement in the option price compared to the stock price, you can see they diverged. Okay. But again, this is part of the Black-Scholes formula. The options market right now is calculating that, hey, the ETF, it went up, but not enough. Okay, it might not even reach 316. And so the options market is not too happy that it didn't go up enough. They wanted to see it go up more. In comparison to the strike price. Okay, let's take a look at out of the money. Is out of the money any better? Well, let's take a look at 317. That's worse, much worse. Down over 50%. Okay, down 53% in one day, mind you. All right. And then when you go further out of the money, it's even worse. Down 80%. You get the idea, right? 84%. So yeah, the further you go out of the money, the worse it is. And so if you buy an out of the money option, yes, you could stand to gain more. For example, if the underlying ETF here, if it went way up today, if it went up to like 330 or 340 or something, then yeah, the out of the money options would have done really well. I've seen out of the money options go up 100%, 200, 300, or even 1,000% sometimes. But what's the likelihood of that happening? What is the likelihood that this would have gone up to 330 or 335 or 340 today? Pretty low, right? Considering that yesterday it was around 313, something like that. Okay, so that's a gamble. That's a lot more of a lottery ticket, and I don't usually recommend lottery ticket plays. Maybe for a small amount if you're willing to throw away that money, but I usually don't recommend it. All right. So so again, let's go back to at the money. At the money went down. It went down even though the stock went up or the ETF went up. What about in the money? Aha. Let's look at 315. The in the money, the one strike in the money one, it went up 11 or 12%. How about two strikes in the money? Let's take a look at 314. Went up 21%. So can you see why I'd rather buy something in the money? Okay. You're not asking too much of the stock or ETF. You're not asking it to go up, 30 or 40 or 50%, okay, or even 10%. You don't need that much. You only need it to go up a little bit. And in some cases, you don't. If you make it a spread trade, you may not need for the underlying stock or ETF to go up at all. But that's a different topic entirely. All right. What if you go deeper in the money? Let's look at 313. It went up 26%. 312 went up 29%. But there's a limit to it. I mean, if you bought the 300, look at that. That's way in the money, but it only went up 11%. Okay. If you bought the 290, it only went up 7%. So there's a limit. And also buying a 300 strike or a 290 strike, that would have been really expensive. I mean, how many people want to shell out, it gets into the thousands here, okay? Because this has a 100 multiplier. So you have to multiply this by 100 if you're going to buy or sell it, right? So when you go too deep in the money, it becomes prohibitively expensive a lot of the time, to where you're risking a lot of money, thousands of dollars potentially. And the gains, there's a limit to the gains. All right. So one or two strikes, maybe 3 or 4 strikes in the money at most, is usually that sweet spot that I look for. All right. As a buyer. Same with puts, by the way. Let's change it to puts. This is tougher because this went up, not down. Okay. So the puts are not going to do well on a day like this when the stock or ETF went up. But let's look at the money. Let's look at 316. Okay. Yeah, got hit really hard. Down 72, 73%. Okay. So let's look at, in the money, which in this case would have been, let's say, 320, lower than the current share price. Went down, a lot, but not as much, 31%. Okay. And then you go to, let's say, 325, only went down to 13%. Okay. And the out of the money ones obviously would have been devastated, like a 310, down 93%, 94%. You get the idea, okay? So buying options that are out of the money, usually not recommended. They do great when things go your way with the underlying asset, when it shoots up or shoots down, depending on whether it's a call or a put. But how often does that happen? What's the likelihood? Okay, I don't recommend trading on possibilities. I recommend trading on probabilities. That's the way to go. Now, if you're a seller, it's the opposite way of thinking. You want to sell something that's going to deteriorate. All right, and so going back to the calls, if you sell something, at the money or out of the money, Okay, let's say if you had sold a 320, you would have done great today if you had sold it, because what you had sold would have gone down in value considerably, 91, 92%. Now, on the other hand, you wouldn't have gotten paid much, okay, for selling that. Well, it depends when you sold it. Whereas, if you sold at the money, let's do a 316 at the money, okay, yeah, you wouldn't have gained as much today just from the loss in the option price, but at least you would have gotten paid a reasonable amount. So you have to weigh it out. I don't recommend selling in the money usually. There are exceptions, but because as you can see, if you had sold an in the money call, you would have had a loss today, right? Because that call option price went up, 24%. Okay, so I like to usually sell at or out of the money options, and I usually like to buy at or even better in the money options. Maybe a couple of strikes in the money is pretty good, or even one strike, depending on the price of the stock or ETF. So I hope that gave some insight into what I'm thinking as far as stock price selection goes. This is only a handful of examples. I only used SPY, but it's pretty uniform when you sell at or out of the money, and when you buy at or in the money. Generally, I've found that people tend to do better. They get better outcomes most of the time, not always. All right. So again, if you want more coaching, if you'd like some help putting together a trading or investing plan, because you really should have one so that you know where you're going and really know what you're doing, then you can email me for that. My email address is davidmodell@gmail.com. I want to thank you for watching and listening. I will talk to you again soon.